So we're going to move on to our last session of the day and take you to Denver, to the team there. We've looked at European and Asian equities over the past few days, but it's time for the outlook from the United States. So good to see you, John. John Ingram is going to be moderating this session with his team.
I am joined farther on the right by Doug Rao, one of our senior portfolio managers. Doug is a very accomplished large cap growth investor for us here at Janus Henderson. And then immediately on my right, I'm joined by Brian Demain. Brian runs our mid-cap strategy team, the enterprise fund, and our other mid-cap strategies. Brian has been on board at Janus Henderson since '99, and the lead portfolio manager on our mid-cap strategies since 2007. So another very, very accomplished investor. So why don't we go ahead and get started? We're going to talk about U.S. equities today. And again, these two gentlemen kind of span the cap space from mid up to large, and the new term giga cap now, right, Doug, that Doug gets to play around in. But I think where I think we want to start is there are so many factors affecting equity markets today. You've got the Fed, you've got supply chain issues, you've got monetary fiscal policy, you've got geopolitical things going on. But I think here, I don't know, a couple hours ago, the topic du jour of the day might be inflation. And so why don't we go ahead and start with how you all are thinking about your spaces, mid, large, Doug. Why don't we start with you, Doug, just in the large cap space? You know, it's a CPI number, 7.5%. How do you look at your companies, evaluate your companies? I know you're in the middle of earnings season right now, but how are you thinking about that as you go forward? A 7.5% number, not that high since '82.
Yeah, thanks for the question. It's an important question that I think every investor is wrestling with today. And we tend to think about it sort of break it into two components. The first component is goods. And one of the reasons goods inflation is so exacerbated today is because of what happened with COVID, which was most companies thought demand was going to collapse, but instead central banks around the world and governments around the world flooded liquidity into the markets. And so consumer spend skyrocketed. At the same time, consumers couldn't access the physical economy. So they were buying more goods. At the same time, the supply chains kinked up. And so we think many of those issues are actually temporary in nature and will resolve as we go through the year. And hopefully as COVID abates, we'll see a transition to services. I think one of the challenges is that services is more U.S. labor intensive. Most of our goods are not produced in the United States, but most of our services are. So we're going to have to try to find jobs, but what it really means, we think, is that wages are going to continue to go up. And so there's sort of two components, as I mentioned. We think the wage inflation is here to stay. And part of that is really just also a function of the fact that we're probably in the third year of deglobalization. So for 30 years, globalization drove deflation in the US economy and drove deflation or the lack of inflation for low-end wages in this country. But if we believe deglobalization is really the reindustrialization of the United States. And so that is going to force wages up, which is going to provide living wages for people, but will also put a lot of pressure on corporate profits. And so for us in the large cap space, luckily we have a number of wonderful companies where we can invest that have great pricing power. They have very high margins, and they don't have a lot of labor intensity as an input to their models. So we will continue to focus on investing in those types of companies.
Yeah, and I would add a couple of points. I mean, when you think about why inflation matters for equities, you know, you've got your PE. How does it impact your earnings, and how does it impact your PE? And I think Doug touched on the earnings impacts in that, you know, we're seeing these transitory drivers of inflation on the goods side, and we'll see how it kind of bleeds through to the services side of the economy. But I think the key point for us as growth investors is that if you look at what makes up the growth landscape in the U.S., it's tech, it's healthcare. There are other sectors in communication services. There's other sectors involved that have narrower margins. But when you look at tech and healthcare, which are over half of probably both of our benchmarks, you know, these are companies with 60 or 70% gross margins, 30% operating margins. That's not to say inflation doesn't matter to earnings for these companies, but this is very different than the 1970s, where we had a much more goods-driven industrial type of economy. So the earnings impact is probably a little less pronounced. Now, the PE impact is actually quite relevant. And if you think we've had this dynamic of very low interest rates and inflation kind of since the global financial crisis, and you'd hear these dynamics of, oh, well, if the 10-year is trading at 1%, that's 100 PE on the 10-year. Therefore, we can pay exceptional multiples for growth companies. Well, that really changes when the 10-year at 2%, and if the 10-year is on its way to 3 or 4, it'll continue to evolve. I think I would agree with Doug that some of the inflationary tendencies we saw in 2021 will ease into 2022, but I do think that over the next 3 to 5 years, inflation is going to matter. It's not that the absolute level of inflation will stay at 7%. That's clearly going to come down, but it's going to be higher than it's been over the last decade, and it's going to have a higher standard deviation around it. And that is quite relevant in terms of how aggressive the Fed response is and how it impacts the investment debate broadly.
So not necessarily just transitory in the next few months, but you think it's going to be around for the next 3 to 5 years.
The 7% is transitory, but I don't see us back at 1 to 2%.
Perfect. And Doug, does that change how you perceive your companies? I mean, do you look at them differently for that as you're modeling out your beliefs in revenue streams and free cash flow? Does that change?
No, I don't think so. I mean, I think as Brian mentioned, stocks are a function of two things: the earnings and the earnings growth, and then the multiple the market's willing to pay for that earnings and earnings growth. And so we fully are expecting that as rates continue to rise, that the earnings multiples will contract. And so we are looking for companies that can outrun through their growth the multiple contraction that we're going to see. I think, where you get into discussions around portfolio construction is at what level of Fed funds rate does the economy slow? At what level does that pinch housing? At what level does that pinch autos? As we know, most American consumers purchase a monthly payment. And if monthly payments are going to go up, that will slow things. So there's a lot of dynamics at play, but in terms of how we're thinking about the companies we're investing in, I don't think much has changed.
Okay, we can probably talk on inflation for a very long time, but why don't we move on to a couple of other hot topics of the day. Obviously, you have the impacts of COVID globally, regionally, however you want to look. How are you thinking about the whether it's the turn back on trade, all of the dynamics that go on in your respective spaces? Brian, I'll start with you. What sort of has transitioned, and what have you learned, call it, in the last 18 months of this pandemic, and how is that going to change the way you look at your portfolios and companies?
Yeah, I mean, I think obviously there's been a lot of talk about digital transformation in e-commerce and the like, and I don't think it breaks new ground to rehash that. I think what's going to be relevant going forward in the mid-cap space is the impact of kind of the dramatic fiscal and Fed response we saw, and then as we kind of pedal that back here over the next few years. In 2021, there were over 900 IPOs, which historically the trend has been closer to about 180 a year. That's kind of the average over the last 20 years. And for us in the mid-cap space, that's particularly relevant. That's a lot of new companies coming to market. And because of the easy money dynamic we've had in place, a lot of those companies have pretty questionable unit economics. They're growing very quickly, but if you actually scrutinize the P&L, there are real challenges there. And the fact they've been able to get public is really kind of quite stunning. And I think also relevant is, as we've had this, the easy money response, we saw valuations get bid up for a lot of companies in the mid-cap space. I think the numbers we've looked at, over 20% of our index is trading at over 15 times enterprise value to sales. That's in the mid-cap growth universe. And I think some of the dynamics in small and mid-cap growth, kind of as a result of the response to the pandemic, have been pretty unprecedented. And the analogy that I like to draw is to the late 90s. And we can talk about these IPOs and compare them to the pets.com, and that's interesting. And it's kind of where the discussion is in the media. But the analogy for the real mid-cap companies is really more to what the large cap companies looked like in the late 90s. And if you think about the late 90s, you had companies like Oracle, Microsoft, Intel, Home Depot, that got bid up to 50, 70, 80 times earnings. And these companies grew earnings for 15 plus years after that at double-digit clips. And yet the stocks were generally pretty dramatic underperformers. And I think we see the potential for a lot of that in some of the more highly valued names as we kind of leave this sort of post-pandemic, this pandemic-driven sugar high in terms of fiscal and monetary stimulus.
And Doug, maybe a little alter on the question for you. You know, going into the pandemic, obviously you run a concentrated large cap portfolio. You know, you had themes in your mind that you were going in. What has been accelerated? What may have been disrupted and has kind of slowed down during that, you know, call it the last 18 months versus where we were in 2020?
Yeah. You know, Brian used the term digital transformation, and we use it a lot, and it means a lot of different things. But I think the one, probably the most important thing that we learned through the COVID crisis was that direct digital relationships with your customers matters a lot. And so some companies had it, most companies did not. So all companies scrambled to build better relationships with their customers. And the reason they did was, one, the customer wasn't accessing the physical economy, but two, companies that have direct relationships are more resilient, and they not only are they resilient from the ability to constantly communicate with their customer, but they can learn from their customer. They can learn how to manage inventory and working capital, all of those things. So I think what we've seen across almost every industry is a search and an attempt to access your customer on a more intimate basis. And so I don't think that has changed. I mean, I think, you know, a simple example is what we're seeing with retailers. They've all become omni-channel. What Zoom is to the workforce, telemedicine is happening, online dating. I mean, none of this stuff replaces the real world, but it can become a substitute for the real world at certain points in time. And so I think that's probably the primary thing that we've seen from an investment standpoint that is important, and I think has made almost all companies better for that. In terms of things that, I mean, you know, it's the obvious things that have been stunted. I mean, travel, the ability to see family and friends and access the world and experience things. I think those will come back with a vengeance. And you see every time the COVID waves abate, people start traveling again, and then the cancellations happen again. And so once we get through that, I think international travel will really explode.
Brian, maybe a question for you around kind of some of the recent volatility, and even looking back on the last 18 months, you know, you had a stretch where it seemed like it was a fairly low quality rally, kind of in or low quality firms, companies were doing much better. You maintained an incredible amount of patience, stuck to your process, stuck to your smart growth strategy. You know, talk to us about maybe a little bit of how that's going to play out, because you've seen now companies that you traditionally have stuck to your guns are performing very well, and your performance has resonated. So, you know, talk to just how you don't want to maybe go with the flow during those times of underperformance, and how you really stuck to your guns and stuck to the process, and you and Cody did an outstanding job.
Yeah, so we had a challenging performance year in 2020, but we've made most of that up here in 21 and 22 as the markets cooled a little bit. And, you know, I would push back a little bit in saying there were elements of the rally that were certainly low quality. There was a lot of very speculative activity getting back to that IPO point. There also were a lot of really good companies that were bid to very stretched valuations. And the digital transformation that Doug discussed is very real. But there are certainly companies that have seen, you know, the demand dynamics around that vary company to company. There's companies that have kind of a long, slow burn in terms of their growth there, and there were other companies that, you know, pulled it forward. I mean, Zoom is, you know, kind of the quintessential example of that, right? It's a great company, but all of the demand came in a 6-month period. And for us, you know, look, we've been using the same investment process for our mid-cap growth strategy for 20 years, and it's proven exceptionally effective over that time. And it's nice and the team that's been doing it has been in place for that whole time. And so having a proven process we believe in is really nice during challenging times, because it we're always questioning what's changing in the economy and what's changing with companies, but we know that ultimately stocks are worth the sum of their, the future value of their cash flows, the quality of management matters, the duration of growth and the pace of growth and the return on capital matters. And so we, ultimately that's our true north, and we're able we were able to stand by that. The period we saw, both the pandemic and the policy response are, truly unprecedented. And so I think it's going to take a couple of years still for the economy and the markets to really sort through what we've been through. So we're staying true to our process. I think the real story on what this has meant for company fundamentals on an enduring basis is still being written.
Love that. And Doug, kind of in your space, obviously the recent volatility with, companies like Meta and some of these other giga cap stocks. How do you play in a space where you've got an index, the Russell 1 that's being controlled, at 40%, you're trying to compete against that type of index, and yet you've succeeded in very positive ways. How do you think about that from you have such concentration in that top end of the marketplace? How do you translate that into excellent outcomes for clients?
Well, I like to joke that I'd like to have any other index other than the one that I unfortunately am competing against, because these companies that have these, $2 trillion valuations are truly the best companies in the world. I mean, that's why they're where they are. They're not there out of, maybe Tesla's there out of speculation, but the big platform companies are, they've compounded their free cash flow and at a rate well in excess of any of the other participants in the marketplace. And so they've earned their way to the top. But it's challenging. I mean, there's more factor investing that's taking place today in the markets than I've ever seen. The retail investor is back after being dormant for 20 years. And there's also a lot of policy risk associated with many of these companies that we're talking about. And so, but at the same time, it's exciting because they are, in many cases, they are, I think I saw something last year that just Amazon and Microsoft were like 20% of CapEx in the United States last year. So it's, just remarkable statistics in terms of how they're driving and shaping the US economy.
So maybe we'll stick to, we'll get off that. And since, the last really 20, almost, coming up on 2 years, COVID seems like dog years, right? We've all aged 100 years. But what do you think about right now? What are you thinking about going forward? What other themes, what other sectors, areas of the economy, are resonating to you in the research and ideas that you're thinking about? Start with you, Brian.
Okay. Yeah, I would point to a couple of themes we're thinking a lot about. One is in the mid-cap space, kind of what's relevant to us is analog semiconductors. I think one of the most bankable investment themes over the next decade is the transition to electric vehicles. Autonomous is coming as well, but electric, we know it's coming. The unit economics work. Every legacy OEM is scrambling to ramp up their EV production, and Tesla is growing by
We are going to need some more plugs in the Janus garage too.
That's for sure. And one of the ways we've found fruitful to invest down in market cap is basically selling the pickaxes to the miners. But I know that ON Semiconductor and NXP and Sensata and TE Connectivity are going to sell chips and components that weren't present in internal combustion vehicles, but will be present in electric vehicles. And so that's just a very bankable secular growth theme. Another that sort of fits that pickaxes to the miners in a growing market is bioproduction. And if you think about the history of the pharmaceutical industry, it was basically there was R&D, you would patent the drug, and then there was a sales force. And that's what the business was. The production of the drug, it was some small molecule that was exceptionally easy to produce. As we've had a move to biologics, monoclonal antibodies, proteins, gene therapy, and famously mRNA, the production of these molecules becomes a much more important part of the biopharmaceutical value chain. And whereas production costs in a farmer's P&L was, kind of low single digits. We see that growing pretty dramatically over the next 5 to 10 years. And the companies that are selling the various components, whether it be the media in which the drug grows, or the filters that process drugs, anything sort of in that value chain just has really powerful demand dynamics over the next 10 or 15 years. And you sort of want to invest. I can't change the wind, but I can adjust my sails. We want to invest where the wind is kind of at our back.
Great response. Doug, kind of same question. I mean, how do you, how do you squeeze more out of Microsoft and Google and, all of these giga caps? What's
well, I mean,
for you?
I'd piggyback on Brian's comments. I mean, when Brian and I both look to invest in companies with durable secular growth. And when we say secular growth, we mean multiple years to come. And so we look for areas where there's a lot of investment that is required and that will take years to invest to get to whatever that future end state is. And then we're both looking for very high quality businesses that can capture a disproportionate share of those economics going forward. And so that's one of the reasons we're both excited about electric vehicles, because it's just so clear that that's the future state. To your question, I mean, I think one of the biggest investment themes over the last decade, and it will continue, is the transition of compute from on-premise to the cloud. And so the three companies, Google, Amazon, and Microsoft, I think today are run rating at $125 billion in revenue for their cloud businesses, and all of them are growing those businesses north of 40%, which is just remarkable. So, and we've done so many different surveys of corporate IT departments, and we're still at less than 20% of technology compute instances being put into the cloud. So there's still a long runway ahead for that. And so that's one way you can invest in cloud. Another way, which we all have exposure to, is through semiconductors, because they are providing building blocks for more server demand in the cloud. And so those are areas in addition to what Brian talked about. And then I think the last area that is an area that I think we're exploring more. We have a little bit of exposure, but we talked, I guess, rounding out this conversation, we talked about labor shortages. So the solution to that, and you've seen it in Japan, is you automate everything. And so there's different ways that you can invest in automation. One way would be robotics. Another way is just through software automation and just taking what were manual processes where multiple people touched it to a digital process. And so I think we'll see a lot more of that going forward as well.
No, thank you both. Incredibly insightful. I think, Lucy, with the last few minutes we have, I want to make sure we throw it back to you and see if there were any questions from our audience.
Hey, John, just checking through. I mean, I think you kind of dealt with a lot of it there. There was a question on the sectors that are looking most attractive right now, but I think you covered that off nicely at the end. And I'd just like to say it was really good to hear sort of the positivity and the sentiment from you guys, the wind at your back kind of sentiment that I think we've heard across all the teams around the world. And that was a great session. Thank you so much.
Yes, thank you. We're all looking for the wind at our backs. That's
Where we are indeed.
In everything we do.
In everything we do. Yes.
In everything we do. Great to see you.
Well, thank you very much, everyone, for your time and attention. We appreciate it. And certainly the never-ending goal at Janus Henderson is to create a nice positive return and positive client experience for all of our clients around the globe. So thank you all very much for listening in.
John, thank you so much. And Brian and Doug, good to see you too.